currency markets with respect to outside the dollar. All these markets were going to rally, and they have been correct. And I will go on record thinking that the press conference is not going to take this away. I think the press conference, if anything, is going to accelerate these moves.
Bob, what do you make of it? We've seen a seesaw where stocks dipped lower, and now they're kind of trying to claw into these gains. Where's your attention focused?
Well, there were two options here, assuming that a 25 basis point hike was what happened, and that is what happened. So the Fed could either pause and specifically, explicitly signal that they're
continue increasing interest rates, even with all of the banking drama going on right now.
And it seems to be the latter one.
Here to make sure
I don't think that's necessarily a bad thing. So this phrase, additional policy firming, may be appropriate. Well, okay, they're saying maybe we'll hike in the future, but that's a much weaker version of their prior statements, a much weaker way of saying that we might rise. So that's certainly a bit bullish. And then the failure to really acknowledge the banking crisis is kind of striking. They said recent developments are likely to result in tighter credit conditions, but the effects are uncertain.
Let me mute that guy for 1 second as you watch this. So we've got a couple of topics we're going to talk about today. One is obviously the bank failures that we did. We talked about that last week. Y'all, this is not over, and we're going to go into more detail on that. We've got a portfolio update on a stock that we hold and we like. It's called GameStop, and they had a massive showing yesterday, up currently 40%, I believe, 40% as of a few minutes ago. Yeah, 39% up today. And then the third topic we'll talk about, which you're seeing right here, that is interest rates right now are climbing again. So let's unmute and hear some insight here. Obviously, well, there are 8 people, so we're not going to get too much in-depth thinking. But
it's a thing of beauty.
It's a thing of beauty. What do you make of the statement as we covet the Octabox, and the fact that their prediction of core PCE or inflation is up from what it was, not down?
Honestly, probably not going to get too much insightful stuff at the moment. But let me talk about this with you. This is a very dramatic day, if you will, very dramatic, because with all of the banks and all the drama that has been going on with the banks in the last couple of weeks, what we are finding is that raising interest rates is a direct catalyst that's causing a lot of stress for the banking system. So this is why a lot of people were panicked, thinking, no way, they cannot continue to raise rates. And as they did, let's just have a quick look here. Let's see how is the market doing right now. Hey, they love it. Wow, look at that. Oops. Yes, a massive spike up. This right here is where the news came out that the Fed will raise rates. Now, you guys, you might be thinking, wait, if that's going to be more uncertainty and make life more expensive for average Joe and going to make the cost of doing business more expensive and so on, then wouldn't that be a bad thing? Yes, but we currently live in upside down world right now where this has been happening a lot. I would suspect you'll probably see today finish out strong, maybe even tomorrow. And then as soon as maybe Friday or next Monday, you will see a turnaround and you will start to see the a sell-off coming on again. How strong, I can't tell you, but I'm just telling you that in the last, I don't know, 12 to 18 months, that seems to be what's been going on, where the Fed comes out, kind of spooks the market and says we're raising rates, but then for some reason the market shoots upward only to start falling and trending downward after that. So now let's go back to see. I honestly, you guys, I expected the Fed announcement to come out a little later than this. So let's just check one last time here.
They're going and then fulfill that, and as a result, everything's hunky-dory. You know, they did that for basically every meeting of the past 12 months, and yet the rate hikes still broke stuff. So I don't think we need to be myopic here in looking at the reaction this half hour to a macro effect that's still going to play out for the next year and a half, for quite some time.
You know, Kelly, I think that's exactly right. There's a lot of uncertainty about the outlook right now. You know, what is the impact of all the rate hikes that have happened? You know, that's broadly the story that's going on in the banking system, is they're being impacted by those higher rates. For sure, that won't be the last thing that's impacted. And the Fed, I think, is rightly kind of citing the uncertainty about how exactly that plays out. So I think you're on the right point regarding the uncertainty. You know, I certainly heard in the statement the Fed doing more to acknowledge that uncertainty than they have in the past. There may be more firming, and you know, it's uncertain what the effects are, and I think that's realistic. So I think the Fed, you know, is realistic in citing the uncertainty there. You know, I just want to come back to this idea of financial stability. I think that line that Steve just read about the banking system is safe. I think that's a new addition to the statement. You know, I could be corrected there. And I think that's a theme we're going to hear a lot more about. I think the market over the last few weeks has been trading primarily on this financial stability question. You know, it's not so much about the inflation outlook, it's about financial stability. And so, you know, I think that's a new addition to the statement. I think that's what we're going to hear about in the press conference. That's what matters for the market right now.
Okay.
They need to.
Well, look, for right now, Jerome Powell will come on here in just a little bit, and he will have some words to say, and he'll tell us what he thinks and the reason why he's deciding to raise rates. So until then, though, let me mute this gentleman here. We know what's going on. We know that the rates are being raised, and we'll go along with some of the updates that we were going to go over since last week. So last week was kind of a special week. Now, before I get into this, guys, one more time, this is Ryan Derks. We have a special Derks Financial client portfolio update right now. As always, this is not investment advice. This is just fun commentary. So if you want actual investment advice, if you want to really talk shop, then you need to call me or you need to email me. We need to talk off of a general live stream. Now, let's start back at the banking situation. Let's start this off with a couple of fun memes. First off, you remember what I said last week? The beaches are open. We caught the shark.
I'm pleased and happy to repeat the news that we have, in fact, caught and killed a large predator that supposedly injured some bathers. But as you see, it's a beautiful day. The beaches are open, and people are having a wonderful time.
The beaches are open. We caught the shark. The beaches are open. And then all of a sudden, maybe not so much. Maybe not so much, because right after all of that drama last week, and again, credit to the GameStop people, they've been specifically pointing at Credit Suisse now for over a year, saying, watch Credit Suisse. They're going to be the first big one to go. And what happened last week? After we had our live stream last Wednesday, I believe it was Friday afternoon, Credit Suisse essentially says, we're insolvent. We need some help. Now, did they actually say we're insolvent? No, because they learned from the Silicon Valley Bank drama. Do not come out and say we're insolvent. Be political. Spin this in a very attractive way. Essentially, what they did over the weekend was saying, hey, we're insolvent. We need someone to help us. And I imagine a lot of the suits up in the executive offices were working hard over Friday and Saturday and Sunday. But what they came up with was Credit Suisse to borrow up to nearly $54 billion from the Swiss National Bank. So the Central Bank of Switzerland is going to basically bail out Credit Suisse. But it's not so simple. Actually, Credit Suisse was technically it was absorbed and it was acquired by UBS. And I'll type in UBS. You'll recognize the logo here. UBS Bank. You guys recognize this one here? UBS. That's UBS. It's the other big bank in Switzerland. Now, UBS, though, it's not so simple. First off, UBS said, we don't want to do this. So if we do it, we're only going to buy it for about 30 cents on the dollar. And that's what they did. Not only that, but they said also strings attached on this deal. We want the Central Bank of Switzerland to guarantee against losses. We're willing to take this much in losses on this deal, but if it gets much bigger than that, we want the Central Bank of Switzerland to totally back us on that. So that is shocking. Now we have a look at Credit Suisse, and Credit Suisse stock is kind of going side. But this is Friday when they said we're insolvent. They were down 60% Friday evening. Now, fortunately, they had the weekend to work all the kinks out, but poor Credit Suisse, they are down to 93 cents a share right now. Now, not only that, but bondholders were wiped out, meaning they basically marked all bonds at Credit Suisse down to zero. Okay, big deal, Credit Suisse bonds. Why is that a big deal? Why is that a big deal? Well, because there were Credit Suisse bonds wiped out. How many billions of dollars? Oh, 17. That's right. Right here. 17 billion. Oh, gosh darn it. I keep clicking on these articles. Again, you guys, this is what happens when it's just you and me. I click on articles with a paywall, but you can see the headline. $17 billion worth of bonds just became worthless. Those are in your mutual funds. Those are in the teachers' pension union investment. Those are in city, state governments. These are all across the place, and $17 billion worth of them just went down to zero. But hold on, the drama is not over because, whoops, Monday evening, UBS set for talks with Michael Klein to terminate Credit Suisse investment bank deal. Oh, the people at UBS had enough time to actually think on what they were doing, and they came back and said, "You guys, this deal doesn't look so good. We don't think we actually want to go through with a buy-in. We actually think we're just going to let you fail." But let me read this to you. This is very important. It says, UBS is set to enter talks with Michael Klein to terminate a deal that would have seen the Wall Street dealmaker take control of much of Credit Suisse's investment bank, the Financial Times reported on Tuesday. UBS on Sunday agreed to buy rival Swiss bank Credit Suisse for $3 billion in stock and agreed to assume up to $5 billion in losses in a shotgun merger engineered by Swiss authorities to avoid more market-shaking turmoil in global banking. Klein, a veteran dealmaker, was merging his eponymous advisory boutique into Credit Suisse's investment banking operations to create CS First Boston as a standalone business which would have led from New York. UBS has now assigned a legal team to examine how to void the contract Credit Suisse signed with Klein in the cheapest way possible, blah, 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 blah. So essentially, they're backing out. Now, I don't think they'll fully back out. I think this deal will go through. It's honest to goodness, it's probably just they're going to change terms of this because, quite frankly, UBS, Credit Suisse, and the Swiss Central Bank can't afford for Credit Suisse to just go under. So with that said, some funny memes have been coming out over the week. Here's a good one for all of you guys who like to watch Squid Games. Here's FTX walking up to Credit Suisse. "Why are you here? I thought you were financially stable." You guys remember that one? Here also for your viewing pleasure, for those of you who are visual learners. Now this doesn't have Credit Suisse on here, but if you wanted to have a look just visually how big the last week and a half has been compared to 2008, all of these bubbles on the left side, that is everything from 2008. If you look at just these two banks here on the right side, that is last week, not including Credit Suisse. If you add in Credit Suisse, that was about as big as this blue bubble here. So that is just the last week compared to all of 2008. One other little meme that I wanted to show you guys, which blew my mind. I never even thought about this, but check this out. This is Business Insider. Russia is so cut off from the international financial system that the Kremlin thinks Western sanctions have ensured the country against the banking crisis. Did you guys ever even stop to consider that? How unreal to think about that all of these sanctions in the last 18 months to cut Russia off from the global system, whether it's banking or otherwise, may actually have insulated them from this contagion of banking crashes. And again, you guys don't listen to what they're telling you on TV. If they're saying, "Oh, this is just, it's a minor accounting thing. This is not a big deal." It's already in the United States. It has absolutely already spread to over into Europe. Not only Credit Suisse, but you've got I think it was last Thursday or last Friday, the entire big bank too big to fail of France were all frozen from trading. I think it's, if I'm not mistaken, the largest bank in France is BNP Paribas. I'll type this in, BNP Paribas. Again, if you recognize this logo, this is a French bank. They were frozen last week because they were dropping so quickly. In fact, let's pull up their stock here. 5-day. So here they are down. Is that correct? They're down. Yeah, year to date. Let's look at year to date. So when all this stuff started going, at one point they were down about 20%. So anyhow, this is absolutely spreading with contagion. But yeah, I saw this last week, this article, and I thought, oh my gosh, addition by subtraction for Russia. So let's go back real quick, jump back to CNBC just to see if there's anything unique happening, and we'll keep talking about what's happening. No, commercial. I'm not going to waste your time with commercials. Now, you guys, this is a very real deal. This article here, I want to really illustrate how big of a deal this is. A lot of these banks imploding, and then you use your imagination to kind of extrapolate what you think, how you think this could or could not, affect the bigger economy or more people than just you and me. Um, Ohio Teachers Retirement Fund takes massive hit in Silicon Valley bank collapse. The Ohio Teachers Retirement Fund. How many billions is that? Retirement, I'm going to read this here from the article. Retirement funds for public workers in Ohio lost millions after the Silicon Valley Bank collapsed last week, sending the tech and bank industries into a spiral. The Columbus Dispatch reported that Ohio State teacher retirement system took the hardest hit amid the banking crisis. Before the shutdown, the system had shares invested in Silicon Valley Bank worth $27 million, and that made up about 0.3% of the system's total fund. Ohio State teacher retirement system said in a statement. So, blah, blah, blah. Was it a massive amount of their portfolio? No, it was 0.3%. But does anyone want to see 27 million just go up in smoke? No. And what I've been describing to a lot of you clients when you come in or when we talk or anything else is just use your imagination to consider how the stock market was down 20% last year. The bond market last year was down 28%. And then you think of the local, the Teamsters Union pension or the Pipe Fitters Union or the California Teachers Pension Union or the so on and so on. You know about these massive hundred millions or billions of dollar funds that are supposed to be responsible for a guaranteed stream of income in retirement for the participants, whether they're union members or teachers or what have you. This first off, not only was last year a terrible year watching those drop drastically, but it's not getting any better when these banks start to go under like this. Now, granted, fortunately for these guys and everyone else at Silicon Valley, whether love it or hate it, is irrelevant at this point. But the government basically said, no matter what, we're going to bail these guys out. Nobody's going to lose money. So everybody is safe and secured right there. With that said, though, what about the other banks? Did you guys see? Hang on one second. What about the other banks? Ah, here. Now, I don't have there was a chart that I had the other day, and I apologize, you guys. Again, this is just you and me here. I don't have it. I couldn't find it before I went live. But I had a chart that I had saved that looks very similar to this, except it showed like top 10 banks. It had UBS and Credit Suisse and Deutsche Bank and some other big ones you know the name of. This is the cost of insuring UBS right now. It has absolutely spiked. And if you think that's high, you should see Credit Suisse. Credit Suisse is even higher. This chart here, for those of you who are just sitting there thinking, Ryan, what in the world are you even showing me? This is a credit default swap. This is an investment instrument that can be bought, and the way you get it's insurance. It is you get paid out if, for example, in this one right here, UBS Bank goes bankrupt. If UBS goes bankrupt, then you will get paid out. And so, as all insurance companies do, they take the information available and then they put together, okay, well, the odds of that happening are not likely. So let's buy volcano insurance here in Kansas City, Missouri. That would be pretty darn cheap. But if you bought, say, fire insurance against your house here in Kansas City, that would be a little more expensive, right? You guys understand that. The cost to insure, the credit default swap rates on UBS have spiked. They were down at 60 and they've spiked up to 153, and that was as of last week. They are higher today, I know for a fact. The three biggest that have spiked in the last 7 days is Credit Suisse, UBS, and Germany's Deutsche Bank. Those are the three that have spiked the hardest right now. And what does that mean? Again, let's explain this to a fifth grader. That means the risk of those banks going insolvent is going astronomical right now. It's spiking very, very, very quickly. Not only that, but let's look at American banks. So here in America, at the end of the day, banks close at 5. They balance their books, And then if maybe Bank A has an extra million on hand and Bank B is short by $1 million, they'll go to what's called the discount window overnight. That's basically the Fed. They call the Fed and say, hey, shoot us $1 million, or hey, we've got an extra $1 million. Just in the last couple of days, this is the last 20 years of the discount window. You can see, you can see what happened. This is the discount window usage overnight during 2008, meaning the banks were nearly insolvent. So every night they were asking for a lot of money. And you guys, here's 2020 with COVID, and here's 2023. What the hell? How high does this line go? Oh my God. At its peak, it just went over about $100 billion in 2008. Just last week, and this isn't even every bank. In 2008, it was every single bank asking for money. Here now, just as of last week, $152 billion in the discount window. The banks are going overnight to the Fed and saying, hey, so we're trying to balance our books, but not only are our investments down, not only is our collateral lowering in value, not only are depositors coming and doing a somewhat run on the bank, but we're short, and not just short by a little bit. So you guys, again, very, very concerning when you might turn on the television and they try to tell you, oh, all is good, all is fine, don't stress. But the truth is, behind the scenes, everything's not very perfect. So before I show you a video that's going to really hammer this home, let's check on, it should be any minute now. Yeah, it should be any minute that Jerome Powell will have a little conference call. So this will be perfect. We ought to wrap this up. Let me go back to show you this video. All right, now this is a 4-minute video, so I beg you just have some patience. Janet Yellen was hauled in front of the U.S. Congress last week, and they wanted to talk about banks. Janet Yellen is in charge of the U.S. Treasury. She's, basically the lifeline of the banks. So here, this guy wants to ask her, hey, you bailed out the big banks. What about the little guys? Now, you guys, I don't think this bank run is over with, but I'm not certain. I'm not convinced that this bank run will be like Mad Max, where we fall into an apocalypse. I think it's a little more devilish than that. I think what you're seeing are some financial games being played that are going to seriously stress the small banks and the medium banks. And what you'll see is the banking sector completely consolidate into 3, maybe 4 banks: JP Morgan, Bank of America, and your guess is as good as mine on the third. Wells Fargo is terrible, but listen to what he's asking. He's asking very clearly, all right, you just bailed out some of these banks here. What happens with the smaller banks? And then listen to Janet Yellen when she actually gets stumped and she has to try to figure out how to justify bailing out certain banks versus others. And she calls certain banks systemically important. You remember that during COVID, we had that term, what do they call essential? Yeah, essential workers. So check this out.
Will the deposits in every community bank in Oklahoma, regardless of their size, be fully insured now? Are they fully recovered? Every bank, every community bank in Oklahoma, regardless of the size of the deposit, will they get the same treatment that SVBP just got or Signature Bank just got?
A bank only gets that treatment if a majority of the FDIC board, a supermajority of the Fed board, and I, in consultation with the president, determine that the failure to protect uninsured depositors would create systemic risk and significant economic and financial consequences.
So what is your plan?
We made that determination.
Right. So what is your plan to keep large depositors from moving their funds out of community banks into the big banks? We have seen the mergers of banks over the past decade. I'm concerned you're about to accelerate that by encouraging anyone who has a large deposit in a community bank to say, we're not going to make you whole, but if you go to one of our preferred banks, we will make you whole at that point.
Look, I mean, that's certainly not something that we're encouraging.
That is happening right now.
that is happening because depositors are concerned about the bank failures that have happened and whether or not other banks could also
No,
fail.
it's happening
And
because you're
it's-
fully insured no matter what the amount is if you're in a big bank. You're not fully insured if you're in a community bank.
Well, you're not fully insured. And
You
the big-
were at Signature, and it just barely met that threshold. You were at Signature.
Well, we felt that there was a serious risk of contagion that could have brought down and triggered runs on many banks. And that's something, given that our judgment is that the banking system overall is safe and sound, depositors should have confidence in the system, and we took these actions.
So there's a
to
special
discourage-
assessment that's been
should
done
have
on community banks in my state and all banks across the country. Was there any discussion that that special assessment would only apply to the larger banks, or was it always assumed the special assessment?
So I'm going to pause it there for a second, you guys, because I believe Jerome Powell's about to speak. But essentially, this guy here from Oklahoma is quizzing her, hey, are you going to just bail out the big banks, or what about the depositors at small banks? And if you keep watching, at the very end, she basically says, well, look, we've got the ones that are systemically important, and those are the ones that we're going to, really focus on. So, that's what we're planning to do. So anyhow, let me pull this
cycle. The upper end of the range now is 5%. Maybe you can soon declare some sort of victory on that.
Like I said, any minute now, Chairman Powell's supposed to come on and talk about this. Now, here's the thing. You guys, if you watch this video, these live streams that we do, you're going to be 10 times more educated than the average Joe on what's going on.
Afternoon.
Even though with this, though, this is some very high-level
Before discussing today's
talk
meeting,
and,
let me briefly address recent
collegiate,
developments in the
graduate
banking
level
sector.
language. But let's hear what he has to say.
In the past 2 weeks, serious difficulties at a small number of banks have emerged. History has shown that isolated banking problems, if left unaddressed, can undermine confidence in healthy banks and threaten the ability of the banking system as a whole to play its vital role in supporting the savings and credit needs of households and businesses. That is why, in response to these events, the Federal Reserve, working with the Treasury Department and the FDIC, took decisive actions to protect the U.S. economy and to strengthen public confidence in our banking system. These actions demonstrate that all depositors' savings and the banking system are safe. With the support of the Treasury, the Federal Reserve Board created the Bank Term Funding Program to ensure that banks that hold safe and liquid assets can, if needed, borrow reserves against those assets at par. This program, along with our long-standing discount window, is effectively meeting the unusual funding needs that some banks have faced and makes clear that ample liquidity in the system is available. Our banking system is sound and resilient with strong capital and liquidity. We will continue to closely monitor.
Just FYI, that's exactly what Silicon Valley Bank said a day before they went insolvent.
To keep it safe and sound. In addition, we are committed to learning the lessons from this episode and to work to prevent events like this from happening again. Turning to the broader economy and monetary policy, inflation remains too high and the labor market continues to be very tight. My colleagues and I understand the hardship that high inflation is causing, and we remain strongly committed to bringing inflation back down to our 2% goal. Price stability is the responsibility of the Federal Reserve. Without price stability, the economy does not work for anyone. In particular, without price stability, we will not achieve a sustained period of strong labor market conditions that benefit all. The U.S. economy slowed significantly last year, with real GDP rising at a below-trend pace of 0.9%. Consumer spending appears to have picked up this quarter, although some of that strength may reflect the effects of swings in the weather across the turn of the year. In contrast, activity in the housing sector remains weak, largely reflecting higher mortgage rates. Higher interest rates and slower output growth also appear to be weighing on business fixed investment. Committee participants generally expect subdued growth to continue. As shown in our summary of economic projections, the median projection for real GDP growth stands at just 0.4% this year and 1.2% next year, well below the median estimate of the longer-run normal growth rate. And nearly all participants see the risks to GDP growth as weighted to the downside. Yet the labor market remains extremely tight. Job gains have picked up in recent months, with employment rising by an average of 351,000 jobs per month over the last 3 months. The unemployment rate remained low in February at 3.6%. The labor force participation rate has edged up in recent months, and wage growth has shown some signs of easing. However, with job vacancies still very high, labor demand substantially exceeds the supply of available workers. FOMC participants expect supply and demand conditions in the labor market to come into better balance.
Which I don't understand still. He says, and I cannot tell you how many clients and business owners I've talked to, they say the labor market is tight, but there's still a huge demand for skilled workers. Where is everybody? How is everybody getting along? I know, anyway.
Over the 12 months ending in January, total PCE prices rose 5.4%, excluding the volatile food and energy categories. Core PCE, excluding those, core PCE prices rose 4.7%. In February, the 12-month change in the CPI came in at 6%, and the change in the core CPI was 5.5%. Inflation has moderated somewhat since the middle of last year, but the strength of these recent readings indicates that inflation pressures continue to run high. The median projection in the SEP for total PCE inflation is 3.3% for this year, 2.5%.
So again, I kind of warned you guys, a lot of this stuff sounds very graduate level conversation, so don't get too concerned about all that, but doesn't it kind of sound like he's reading a hostage letter right now?
Despite elevated inflation, longer-term inflation expectations appear to remain well anchored, as reflected in a broad range of surveys of households, businesses, and forecasters, as well as measures from financial markets. The Fed's monetary policy actions are guided by our mandate to promote maximum employment and stable prices for the American people. My colleagues and I are acutely aware that high inflation imposes significant hardship as it erodes purchasing power, especially for those least able to meet the higher costs of essentials like food, housing, and transportation. We are highly attentive to the risks that high inflation poses to both sides of our mandate, and we are strongly committed to returning inflation to our 2% objective. At today's meeting, the committee raised the target range for the federal funds rate by a 0.25 percentage point, bringing the target range to 4.75% to 5%. And we are continuing the process of significantly reducing our securities holdings. Since our previous FOMC meeting, economic indicators have generally come in stronger than expected, demonstrating greater momentum in economic activity and inflation. We believe, however, that events in the banking system over the past 2 weeks are likely to result in tighter credit conditions for households and businesses, which would in turn affect economic outcomes. It is too soon to determine the extent of these effects, and therefore too soon to tell how monetary policy should respond. As a result, we no longer state that we anticipate that ongoing rate increases will be appropriate to quell inflation. Instead, we now anticipate that some additional policy firming may be appropriate. We will closely monitor incoming data and carefully assess the actual and expected effects of tighter credit conditions on economic activity, the labor market, and inflation. And our policy decisions will reflect that assessment.
All right, so I'm going to mute him for just a moment while he finishes off.
An appropriate path for the federal funds rate based on...
Okay, he'll probably do some Q&A here in just a second, but what he just said doesn't make sense at all. He said about 90 seconds ago that inflation is still far, far, far too strong and far too high for what they're comfortable with. They want inflation down to 2%, and he just read off PCE, ECP, PPT, ABD, all those different numbers, and he just told you they're way too high. But then he says, so we're going to raise rates by 0.25 point, and we think we might be able to pause increasing rates from there on out because we think that's going to do it. He just said right before that wasn't going to be, that they're far, far, far from their target. But then I guess he thinks that raising 0.25% will get them to that target. And you guys, here's the deal. this is just Jerome Powell. There's a whole group of people behind him, and he really is reading more or less a hostage letter, because if he says the wrong thing, or if he stutters, or if he mispronounces a word, he could have the stock market in a massive sell-off. So he's got to be very careful. However, even with all of this said, right here, we're only a few minutes into this whole thing. I don't think it's over. I don't think that raising rates is going to be done here at all. He's going to continue, and he's been very straight for months now, especially what was like 2 or 3 weeks ago when he was in front of Congress testifying about all of this. And he said, hey, what do you want me to do? Inflation is out of control, and we have to raise rates to get it under control. So let's see here. I think he's about to do some Q&A.
Thank you. Colby Smith with the Financial Times. How confident is the committee that the recent stress that we've seen and you've alluded to is contained at this point, and that deposit flight among mid-sized lenders in particular has ceased?
Thanks. So I guess our view is that the banking system is sound and it's resilient. It's got strong capital and liquidity. We took powerful actions with Treasury and the FDIC, which demonstrate that all depositors' savings are safe and that the banking system is safe. Deposit flows in the banking system have stabilized over the last week. And the last thing I'll say is that we're undertaking a thorough internal review that will identify where we can strengthen supervision and regulation.
Okay, just a quick follow-up. I mean, given all of the stress and the uncertainty that you've also alluded to in the statement, how seriously was a pause considered for this meeting?
So we did consider that in the days running up to the meeting, and you see the decision that we made, which I'll say a couple things about. First, it was supported by a very strong consensus, and I'll be happy to explain why. And really it is that the intermeeting data on inflation and the labor market came in stronger than expected, and really before the recent events, we were clearly on track to continue with ongoing rate hikes. In fact, as of a couple of weeks ago, it looked like we'd need to raise rates over the course of the year, more than we'd expected at the time of the SCP in December, the time of the December meeting. We are committed to restoring price stability, and all of the evidence says that the public has confidence that we will do so, that we'll bring inflation down to 2% over time. It is important that we sustain that confidence with our actions as well as our words. So we also assess, as I mentioned, that the events of the last 2 weeks are likely to result in some tightening of credit conditions for households and businesses, and thereby weigh on demand, on the labor market, and on inflation. Such a tightening in financial.
All right, y'all. Look, just out of interest of your time, I'm going to skip past this and get into what we were talking about earlier and finish all of this conversation. Specifically, let's talk about GameStop. So yesterday, GameStop, we've talked about GameStop a lot over the years. A lot of, again, if you're just joining us, it's Ryan Derks. We've got a special Derks Financial Client Portfolio update right now, going over how the banking system is not totally stable, as they say, still, and going over the Federal Reserve increasing interest rates. And then finally, we're ending with GameStop today. So, GameStop. This has been a crazy stock. In fact, there was a comment, and I saved it on my phone here. It was going to be this cover for this video, but honestly, I forgot about it until just now. But somebody had commented about GameStop over the last year, and he goes, "The last year of GameStop, this saga has more twists and turns than a Chinese finger trap." And seriously, GameStop opens this morning up 40%. On great earnings reports, and here is the review of of how their last quarter was. Again, fourth quarter, that is October, November, December. That's it. Now, if you also remember, before I read these numbers, look here. I'm going to zoom in a bunch. I hope I can get it over there for you guys to see this. The analysts and all that, the experts, were expecting them to report a loss of 13 cents per share, and they came in with a profit of 16 cents per share. They beat them by more than I think I saw 220%. They outbeat the experts, the analysts. The analysts expected GameStop to report negative numbers, and they reported great positive earning numbers. So let me zoom back out here, and I'll tell you exactly what those numbers were that caused the price of GameStop to jump by 40% today. Let's see here. Net sales were $2.2 billion compared to $2.2 billion last year. Okay, still though, I mean, it was like 50 million higher or so. Selling, general, and administrative expenses were 453 million, compared to, actually, the easier way to look at percentages. Selling and general administrative expenses were 20% as compared to 24% last year. So they were able to lower costs of running their business. Net income, okay, net sales, big deal. It's here, when the dust settles. Net income was 48 million compared to a net loss of 147 million 12 months ago. So even though sales were roughly the same, they were able to gosh, what's the word I'm thinking of? Restructure how the entire company works, that they cut so much dead weight and they cut a lot of nonsense. This isn't a charity, it's a business. And the business lost 147 million last year, and this year had 48 million in profit income, rather than all with roughly the same sales. That's a huge gain. Inventory, okay, but then the other big one, cash and cash equivalents in marketable securities were 1.3 billion at the close of the quarter. Oh, unreal, absolutely unreal. That any company that was in the position that GameStop was just 2 short years ago when Ryan Cohen took over, now has essentially no debt. They have essentially no debt. They have $1.3 billion of cash, and they're seriously turning the ship around as far as income goes. So that is an amazing. That's basically why you see a massive jump up right now today, up 41% as we speak. Let's look at some comments here in all this. People are talking about how the analysts were wrong. People talking about how much cash they have on hand. A lot of curse words. I'm not going to read them in the comments, but that's what comments are. Okay, it's a lot of goofy comments, so I was looking for something insightful. Actually, you know what? You can usually find something insightful here on stocks. Let me look at this over here. Here's GameStop. Let me see if there's anything insightful for you guys on this. Oh, gosh. This is a hilarious comment that everybody's commenting. We just talked about Credit Suisse, right? This is a comment. Ha! GameStop has enough cash on hand to buy Credit Suisse. In fact, the whole reason Credit Suisse is going under is they absorbed a couple of hedge funds last year that were way upside down, almost 200 to 1 over leveraged against GameStop on shorts, and they went upside down. Credit Suisse absorbed their losses, and somebody else was commenting, shoot, GameStop should just acquire Credit Suisse and unwind all of those bad positions and just get this over with. So that is so funny. Here somebody says, being profitable in this economic environment is an amazing achievement. That is very true. What's the exit strategy? Numbers look great. Awesome job. That gambling sub is probably going ape shit right now. Credit Suisse, blah, 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 blah. UBS is already underwater, blah, blah, blah. Okay. So anyway, I'll show you this as well. This is a very unique thing that they released in their report. 12 months ago, oh my gosh, trying to get this. Down here, you can see this highlighted in red. Proceeds from sale of digital assets, so crypto assets. Now, if you remember, you guys who have been following GameStop, and for those of you who haven't, this is one of the big avenues and revenue streams that they've been very loud and proud about, saying this will be a big deal. 12 months ago, not a penny made on digital sales, crypto sales. This last quarter, just in 3 months, $82 million in digital asset sales. Explosion to the upside on digital asset sales. Good for them. They're executing very well. And here's a top comment. And we're still in beta mode, meaning that their digital assets branch is still just kind of in beta testing mode. So anyhow, that let me see here. Aside from that, I could go into more detail on GameStop, but that's about it for right now. I just want to give you guys some insight. Let's hear a little bit more of what Jerome Powell has to say.
I got the question 12 times, so maybe it's a feature, not a bug. But yeah, absolutely absolutely the same. The story is intact. So it's really 3 parts, right? Goods inflation's been coming down now for 6 months. It's proceeding more slowly than we would have liked, but it's certainly proceeding. Housing services is really a matter of time passing. We continue to see the new leases being signed at much lower levels of inflation. So that's 44% of the core PCE index, where you've got a story that's ongoing. Where we didn't have in February and we still don't have now is a sign of progress in the non-housing services sector, and that is, that's just something that will have to come through softening demand and perhaps some softening in labor market conditions. We don't see that yet, and that's of course 56% of the index. So the story is pretty much the same. I will say that the inflation data that we got, to your point, really pointed to stronger inflation.
If I could follow up on that, I was curious why you don't see more coming from the credit crunch, because it seems to me that's something that you'd actually welcome to a degree and expect. And are you not seeing more coming from that because you don't know, or because you just don't want to have another round of wishful thinking?
So it's really just a question of not knowing at this point. There's a great deal of literature on the connection between tighter credit conditions, economic activity, hiring, and inflation. Very large body of literature. The question is, how significant will this credit tightening be, and how sustained will it be? That's the issue. And we don't really see it yet. It's so people are making estimates, people are publishing estimates, and but it's very kind of rule of thumb guesswork almost at this point. But we think it's potentially quite real, and that argues for being alert as we go forward, as we think about further rate hikes. For us, we'll be paying attention to the actual and expected effects from that.
Gina. Hi, Chair Powell. Gina Smilik from the New York Times. Thank you for taking our questions. I wonder if you could talk a little bit, I know that you've got your internal review coming, but I wonder if you could talk a little bit about what you think happened with oversight at Silicon Valley Bank, and whether this suggests that something about regulation and supervision needs to actually change going forward. And I wonder, how can the American people have confidence that there aren't other weaknesses out there in the banking system, given that this one got missed, as you noted?
So let me say what I think happened, and then I'll come to the questions around supervision. So at a basic level, Silicon Valley Bank management failed badly. They grew the bank very quickly. They exposed the bank to significant liquidity risk and interest rate risk, didn't hedge that risk. We now know that supervisors saw these risks and intervened. We know that the public saw all this. We know that SVB experienced an unprecedentedly rapid and massive bank run. So this is a very large group of connected depositors, concentrated group of connected depositors, and a very, very fast run, faster than the historical record would suggest. So as for us, for our part, we're doing a review of supervision and regulation. My only interest is that we identify what went wrong here. How did this happen is the question. What went wrong? Try to find that. We will find that. And then make an assessment of what are the right policies to put in place so that it doesn't happen again, and then implement those policies. It would be inappropriate for me at this stage to offer my views on what the answers might be. I simply can't do that. Vice Chair Barr is leading this, and I think he's testifying next week. So, but that will be up to him. So that's really where it is. The review is going to be thorough and transparent. It is clear, to your last question, it's clear that we do need to strengthen supervision and regulation. And I assume that, there will be recommendations coming out of the report, and I plan on support.
All right, so far it looks like the stock market is pretty mixed, actually. Overall, it's reacting somewhat favorably. The banking stocks are not so happy right now. They are not reacting favorably. As you can see right there, down 2-3% right now. And perfect, but overall market is somewhat up. In fact, let's just go to, I should have it right here. Where's that heat map? Although this is delayed, but you can kind of see overall what's happening with the heat map of the stock market. But I'm going to end this live stream there. Bottom line, you guys, we have raised interest rates by 0.25%. Right now, the stock market seems to be happy about that, but I, honest to goodness, would not be surprised if here in just 2 or 3 days, you start to see a reversal. What is going to start happening? U.S. Treasuries are even more attractive, and they are risk-free, so you ought to see more money being pulled out of checking and saving accounts, you will see the cost of home loans, car loans, credit card interest rates. Excuse me, I've got hiccups. But all debt will become slightly more expensive very soon. So anyhow, that's what I got for you guys right now. Thank you for watching. Call me, email me, and I will see you soon when we do another live stream very shortly. Thank you. See ya.